got Mint, we've got Swiss Bank as well. 5 bid here, 5.5 off, or even bid now. Once again, paper doing some big time sub-selling there on the cash close here. 4 halves trading it out 5s, trading it out 5 bid offered at 6. 5 half bid at 6. 5 halves trading here, 5 half, 6 even again, half bid here, 5 half the bid offered at 6 even again, half bid. Again, paper doing some selling down to 24 on the cash close here, 5 half at 6 even.
When you look at the evenness of the profit and loss, with the profits stepping up gradually and consistently like a ladder from the low hundreds to the higher hundreds, then from the higher hundreds into the thousands, and on the loss side. With strict control in limiting the losses, you must be wondering, is there a secret technical indicator behind these results, or a magical method yet undiscovered? The answer? There isn't. So what is there? With retail options trading, you must understand which elements of an options anatomy that you can control. When you express the Greeks of an options pricing model, in this case using the Black-Scholes model as an example, the elements of an options anatomy that you can choose to construct into a trade is the relative price to where the underlying product is currently trading based on the strikes you choose, the time to expiration, and the amount of daily implied volatility for you to theoretically price how much to buy or sell on any given trading day. To focus on observing pure price and price alone, let's debunk the retail trading myth popularized by most large retail trading firms. That myth being everyone looks at these charts, namely candlesticks and other time-based charts. Their use of the term everyone translates into retail off-the-floor traders, which only makes up 15%, in some cases even less, of traded volume on exchanges depending on which exchange it is, which raises the question, what are the eyes of those on the floor, moving 80+% of traded volume looking at? Price and price alone. You must be able to relate price to percentiles of a standard deviation curve. Let's take the doji, a well-known candlestick, as an example. The doji is characterized by its open and close at the same price. The high is a different price from the low. To map the doji onto the relevant axes of the distribution curve, I'm going to flip it on its side and graph it. Remember, with a distribution curve, it records price on the horizontal axis and frequency on the vertical axis. So a price that closes at the same price it opened is recorded as 2 price points with twice the frequency of the high and low. Take away the lines joining the dots. Question: where's the doji? Not relevant anymore. Price points are actually sets of dispersed data residing within percentile slices of 1 to 3 standard deviations. Point and figure charting on a log scale basis is the only method of observing price which eliminates the confusion in time-based charts to simulate price-only action off the floor. For those of you who have subscribed to Cry Me a Trade, which is a free service inspired by the open outcry pits of crying out trade opportunities, we are going to take a look behind the scenes. To generate the opportunities cried out in Cry Me a Trade, an applet is used with 5 CSV input files, which then runs parallel algorithmic logic to generate a trading report as the output. Let me walk you through the inputs. The first input is customized point and figure scans from Trader Pro by Updata, which allows for the percentage scaling method with the box size set at 1.0 on a log scale basis. This is to identify upside patterns that have broken out by one box above the breakout box of the top pattern, and consistently for the downside, the customized scan identifies downside patterns that have broken down by one box below the breakdown box of the bottom pattern, and it's also using a percentage scaling method with the box size set at 1.0 on a log scale basis. Updata provides institutional grade point and figure software for customized technical analysis. You can see a whole panel of commercial and private banks are their clients, and it's the professional trading desks of these large financial institutions that use their risk management tools. Other firms that provide P&F charting include Dorsey Wright, as well as Bullseye Broker. But these two other firms are not able to provide log scale based point and figure charts with the inbuilt configurable scans that I've shown. The second input is I volatility. I volatility's advanced ranker allows for robust mean reversion analytics, which measures implied volatility by dividing it against its 52-week high-low range. What it does then is it scales it within a range of 0 to +1, with 0 indicating that a new volatility low has been set, while a maximum reading of +1 means that a new high in volatility has been established. This tool separates the measure and scaling to make the implied volatility of calls distinct from puts. The separation of implied volatility is critical because a debit or credit vertical put consists only of puts, no calls. Conversely, a debit or credit vertical call consists only of calls, no puts. Calls and puts are not theoretically priced at parity. They are not identical in value and equal to each other due to their inherent skewness. And the measure and scaling can be done across the various expiration periods: 30, 60, 90, up to 180 days. The third input is from Think or Swim. During live trading hours, I would take price quotes from thinkorswim using a custom watch list of selected traded products with data for their 52-week high as well as the 52-week low, which will be used to eliminate the underlying products that are trading near their 52-week high and 52-week low extremes. The data would be exported as a CSV file containing the price quotes. Let's run the process to see how long it takes to arrive at a trading decision. While Trader Pro is running the customized scans, and you can see here for 117 candidates, it's going to take less than 40 seconds. I'm going to go into iVolatility to export out the volatility files. For the call IV, I'll rename the file to reflect it is for calls. Now I'm going to repeat the process for puts. The scan for the breakout is already done while I was exporting the files out from iVolatility. So now I'll run the scan for the breakdown. And you can see that it's pretty quick. It's going through 117 candidates, less than 40 seconds. Then from within Trader Pro, what you can do is export out both the breakout as well as the breakdown into a common folder. The quote file from thinkorswim was already exported. The applet is designed to generate a trading report targeted at identifying vertical spreads. This is both debit and credit vertical spreads as well as single options. You will need to generate 5 input files in CSV format to feed into this applet, which then creates the trading report. The first file, the breakout file, this contains the scanned point and figure opportunities as upside trades. The second file, the breakdown file, this contains scanned point and figure opportunities as downside trades. Thinkorswim quote. This file contains the prices of a finite list of specific traded products with the underlying symbols, which I will provide later. File number 4, IV call file, is the implied volatility of only the call options of the specific and finite list of traded products. Final and fifth file, IV put file, is the implied volatility of only the put options of the specific and finite list of traded products. In all the 5 files, there is a common and finite list of specific traded products with their respective underlying symbols, which I will provide later on. To give you a sense of how quick it takes to generate the report, I've already preloaded the applet with the 5 CSV input files. Click OK. And the trading report is created. With the trading report, systematically target trades to fire once, no adjustments. Now, once the trading report is generated with a list of valid candidates, for those of you who want to be doubly sure, on the trading day itself that you plan to fill the trade, during live trading hours, check using stockcharts.com that a breakout remains a breakout for an upside trade, and a breakdown remains a breakdown for a downside trade. So we're going to use these 2 examples, AMZN, Amazon, and AZN, AstraZeneca. So on the day that you intend to fill the trade, the PNF pattern for a breakout that was identified should remain a breakout. And here we see it remains a breakout. And remember, with the scaling method, you need to set it consistent with the same criteria and the conditions that you have loaded into the scan. So the percentage here needs to be 1.0%, box size, 3-box reversal chart. Consistently, and likewise for a breakdown that has been identified in the trading report, that a breakdown does remain a breakdown. So in this case here with AstraZeneca, it does remain a breakdown. And again, the criteria and the conditions: percentage 1.0%, box size 3-box reversal chart. Then you would need to go into thinkorswim to test the spread for the respective trade criteria. So here we have a debit vertical call as an example. So the test scenarios, these are in the trade plans in the HOT business.xls file to test, namely, the theoretical price of the trade's construction, and you would look at the probability of touch as well as the implied volatility and theta test. So as a reminder, in the HOT business.xls file, which you've already been given as part of the original curriculum course, you would test for the construction criteria, the second test, probability of touching test, the third test, implied volatility and theta test, specific to that particular type of vertical. So you would test the criteria for a debit vertical call, alternatively a debit vertical put, or a credit vertical call or a credit vertical put, depending on what the trading report spits out. Because what the trading report will spit out in terms of the potential trade to analyze the strikes is whether it's going to be a vertical or a single put or call option. So remember again, this applet is primarily geared towards verticals, both debit and credit, as well as call or put spreads. With the applet, it's an automated step to combine all the components of an options construction together. Pure price as the backbone of trade selection. Implied volatility as the heart of theoretical pricing. Probability of touch complete with trading plan criteria. Suit up and let your options trading take flight. Retail processes transformed into rapid fire robotic trading. Brought to you courtesy of Home Options Trading.